I do want to go to Luke Lloyd right now, Dave Maney, to get their take on whether today is a reflection of the reality to come, that despite this downdraft in key commodity prices, we're going right back to where we were, or whether, this is an anomaly, what's going on today. Luke, to you first. What do you think?
Yeah, so I mean, the Federal Reserve has barely done anything yet, so I don't think this commodity sell-off is a reflection of the Federal Reserve hiking interest rates, but I think this is a direct reflection of a government-made recession that we're about to enter. I mean, look, politics have really screwed up this economy. Everything from trillions of dollars in stimulus, states that were locked up for years, all the way to Biden's war on oil have contributed to this massive recession that we're most likely going to be entering. I mean, the free markets haven't been free since the pandemic, which messed everything up. Right? And on the other side, I think politics played a large part on the Federal Reserve as well, which we're paying for right now. I mean, many people wonder why the Fed was so late to the game. And I think it's a direct result of political pressure a year ago up until about November when Powell got reelected. The Fed said that inflation was transitory for so long. Well, that's because Powell wanted to get reelected and neglected to get hawkish before that in fear of not getting reelected because cooling the economy would upset Biden. So now everyone's feeling that pressure of policies that didn't look out for Main Street America. And sadly, I think this is just the beginning of that pressure.
What if it's the slowdown that could save the day, though, Dave? By that, I mean these lower rates and what's happening and the fear that maybe the Fed has to keep hiking and that will hammer economic growth all the more if we have growth at all. That's debatable. Then what?
Well, look, Neil, the one thing that I keep saying about this thing is we are, in terms of progress and in terms of change, we are as far from the 1981-82 recession as Ronald Reagan was from the Ulysses S. Grant, panic of 1873. Like, we're in a completely different economy. And yet gray hairs, Neil, like you and I, we're around for that 81, 82 recession. And I think there's been too much, hey, this is how it works when you raise rates. This is how a recession works, and this is the time frame. I don't think we know that. And so I think there's a possibility with instantaneous information flowing throughout economies that things can change and pivot and turn a whole lot faster. I'm not saying it's for the good. I'm just saying it's faster. And so where exactly this is going, I'm not sure, but don't expect this to play out the same way that 1982 did.
Well, it's interesting you should say that. And Luke, on this, I mean, take a look at a 30-year mortgage, which fell for the third week in a row. We're now at about 5.30%. That's down about half a point in what, a couple of weeks here, and well south of the nearly 6% we were flirting at before. I'm taking a look as well at what's been going on right now with both the 30-year and the 10-year today, just today, where yields are backing up a little bit so that maybe the market thinks it overdid it. But do you think now that those rates stay as they are in this neck of the woods now in the mortgage industry, that could change the complexion of that all of a sudden this real estate, I wouldn't call it crash, but correction, doesn't materialize?
Well, I think what we're seeing right now, again, is a direct reflection of the Federal Reserve being late to the game, because what Fed rate hikes were supposed to do was help the middle class, right, by taming inflation. But in reality right now, the Fed has been so late that's essentially a double whammy to the middle class. So not only are prices like houses still extremely high when you go out to buy goods and services, but now the cost of borrowing is crazy expensive, right? So if we were able to tame inflation last year with rate hikes, even with the cost of borrowing being a lot higher for maybe like a mortgage, the middle class would have been a lot stronger and able to afford this kind of stuff. Right now they can't. So a weak middle class means a weak economy. And when you're talking about mortgages, and we were talking about the 1980s, I do think the situation is way worse than the 1980s. Really? 1981 inflation was like 10%. 1981 mortgage rates were 16%. 1981 CD rates were 16% as well. So you could basically put your money in a CD and get the same rate as you were on your house. Right now, inflation's like at 9%, mortgage rates are almost 7%, and CD rates are 2%. So it puts investors in this big dilemma right now because they can't make their money work for them at all outside of the stock market. So do they decide to take on a lot of risk and put their money at risk, or do they keep their cash in savings and lose 10% of their purchasing power, right? It's this big dilemma going on.
Yeah, and I love Luke to death, Dave, but he is young. And I will say, I don't see the 70s comparison here, with all respect to him, because we are in a much stronger economy than we are. He's quite right to point out the anemic CD and savings rates that have not followed what's been happening on some of these other rates. I get that. But the fact of the matter is, jobs are in a much more secure place than they were back during Jimmy Carter. Job growth might be slowing, but we had it reversing back then. So I see us in a stronger position economically, other than where we were back then. I also don't see some of the devil-may-care bubble bursting activity that we saw even with the financial meltdown a little over a decade ago. So I think there are distinct differences here that might shield us from something worse. But what say you?
Yeah, different in a lot of ways. I was thinking about this today, Neil, in preparation for today. And I was thinking, you take this shocking gas price increase, right? And you think about what effects that would have had circa, 1982, when people had and were demanded to be commuting every day. And you think about it now and say, well, yeah, that's right. It would be murder on my commute if gas prices kicked up 200%, but I only have to be in the office 1 day a week or 2 days a week or no days a week. It's different. And so, again, I just look and say, anytime you see or hear somebody saying, hey, this isn't behaving the way I thought it would, I look and say, yeah, because this is the first time. This is a first. And you can get clues, but you can't get a roadmap from the past.
We'll watch it closely, gentlemen. I appreciate both your brilliant perspectives on this. We'll see how it all sorts out. We're a long way from seeing that sorting out stage.